Is QQQI the future of the income fund market? And can they keep up this 14.35 distribution rate? Watch the video and find out. Yo, what's going on, guys? Welcome back to the channel. I would like to start the video off by saying that I am in no way a financial advisor, so this is purely speculative and you don't have to take these tips. This is just kind of insight into investing from a college student who's about to acquire their degree in finance. Starting off this video, guys, I'd kind of like to delve into the wonders of QQQI. Right now, it's kind of a hot stock. It's a monthly distributing income fund. Basically, what that means is there's a net asset value of the portfolio. We have like their weightings and their market value, price, and their shares that they own. So essentially, it's a ETF, and the way they generate this monthly income is through covered call options. So they basically pursue out-of-the-money calls to generate income on top of what their net asset value is in the portfolio. This is kind of like a double positive, as opposed to your typical ETFs where it just increases in value based on the average of all the stocks in the fund. So what this kind of allows for is monthly dividend distribution, so you can kind of compound your growth. And while most companies right now, they offer a dividend yield anywhere from 0 to 5%, they offer in dividend yield. And this fund is kind of, they aim to generate a higher dividend yield while maintaining their net asset value. This fund is actually pretty young. So the fund's inception was the beginning of 2024. And since then, this right here is just kind of a chart of their growth of $10,000 at net asset value since inception. Since inception, if you invested this $10,000 in QQQI, you would have a net asset value of $11,804, which is actually really solid. That's a 11.8% return on investment. When you compare that to kind of how the market is done in 2024, especially late in 2024, it's actually relatively less. So year to date, the S&P 500 is currently up 25.7%. For some reason, this chart's kind of being wonky. So when comparing QQQI's capital appreciation to the S&P 500, if you invested, say, that $10,000 in the S&P 500 in an ETF fund, say in VOO, which is just off the top of my head, you would have closer to $2,500 in return. This is actually the main argument when it comes to these income generation funds. Most people say, well, you could have just stuck that money in the S&P 500 and gotten double your return, which is a very good point. However, I would like to say that regular S&P 500 funds do not distribute monthly dividends. The great thing about these monthly distribution stocks is that you get the opportunity of compound growth. So whenever you get your dividend payment, you can actually reinvest that into the stock, and kind of like a snowball effect, it keeps growing and keeps growing. Now, another one of the main issues with the QQQI fund is how young it is relative to other income generation ETFs, like something like JEPI or JEPQ. JEPI has been around since May of 2020, and if you invested $10,000, they have a similar chart here. If you invested that $10,000, you would have a 76% return, which this 76% is a little misleading because at the beginning of 2020, we had COVID-19. So a lot of this growth could probably be attributed to things reopening, supply chains freeing up, and everything. I would like to make that clear. It's a little bit misrepresented. If the fund had been around since the beginning of 2020, we would have kind of a more accurate depiction of how well the fund's doing. They're up 76%, and when you adjust for the years in the market, they are still doing a little bit better than QQQI on their yearly returns. The main difference between JEPI and QQQI is QQQI's current estimated dividend yield is 14.35%. Currently, they've actually only yielded 10.6%, I believe, since inception, but there's still two months of dividend income that's yet to be paid out. So if you account for those, it should get pretty close to 14. I think probably 13 and some change if their dividend payouts are similar to previous years. Now, another thing that's very important to keep in mind with a fund like QQQI is the expense ratio. They have a 0.68%. And basically what an expense ratio is this is the kind of income that's paid to fund managers to actively manage the fund. So since it's actively managed, they want money for doing their job. Unfortunately for us, the investors, we kind of have to fork that money over. And I believe that the expense ratio is deducted in the dividend. But when you look at it, 0.68%, that's still less than 1%, which is pretty minor. However, when you do compare that to something like JEPI, their expense ratio, I believe, is like 0.35%, so almost half. Their yearly dividend yield is 7.75%. So when you compare and contrast these funds as of this year, QQQI is actually doing better in terms of net asset value. Like I said, they're up. I believe I misspoke earlier. They're actually up 18%. And JEPI is actually only up 15.86% year to date. And QQQI yields almost double the amount that JEPI does. However, the biggest difference between JEPI and QQQI in terms of assets under management is the type of industry that they're in. So QQQI is actually very heavily weighted in the tech industry. As we can see, NVIDIA, Apple, Microsoft, Broadcom, Meta, Amazon, Tesla. I believe Costco is the only one of these here that isn't tech related. I guess you could, technically, I think Meta and Broadcom are communications, but they also kind of fall under the tech industry, sort of. It's kind of a gray area with those kind of communication companies. They're very heavily weighted in the tech industry. And as we know this year, the tech industry has been extremely volatile, especially NVIDIA and Microsoft and Tesla. As you guys could see, in the last 4 days since the election, Tesla's had almost $100 run up, which is actually insane. But this means that the fund's going to have more net asset volatility depending on what you think about the tech industry. I personally believe that it's a little bit inflated and we're due for a market correction. Whether or not that actually happens, we'll see. But when you compare QQQI holdings to JEPI, as we can see, JEPI is way more diversified as far as their percent of net assets. We've got companies like Progressive, which is financials, Train Technology, which it says is a building products industry. We got Amazon, which is retail, MasterCard. So we've got a well-diversified portfolio, anything from retail to healthcare, biotechnology, financial services, electric vehicles, food products, capital markets, literally everything. JEPI is one of the most diversified funds, and that's what makes it a very strong ETF. As far as there's less risk for NAV erosion. So my main bit of advice, which this isn't financial advice, this is strictly speculation advice, basically gambling advice if you'll take that. Income funds that are more diversified as far as the industry and the sectors that they're in are going to do better over time as far as the net asset value goes. Their dividend yield will be a lot lower than these technology sector income ETFs, which is basically what QQQI is. Their yield's going to be a lot smaller, especially in a bull market like we have right now. The good news with that is if the market ever does take a swift downturn, stock price is going to stay, I don't want to say relatively flat, but if there is any decrease, it'll hopefully be minor. And the opportunity for it to come back to its original price is there. Say the entire tech sector has a bad 2, 3, 4 months. That's immediately whatever 3-4 months of your dividend payments are just down the drain. So the only way for these funds to really perform well and be worth it is for the net asset value to trend either sideways or trend up, and the payout ratios to not exceed necessarily what the company can handle. And I personally believe that JEPI has done a pretty good job of this. The fund's 4 years old. They've survived 2022, which was a very bearish market. And so in saying all of that, I personally believe that QQQI's dividend yield is first going to slowly reach down to something similar to JEPQ or JEPI's dividend yield, somewhere in this 7 to 8% yield range, which is still better than most stocks. The thing that we don't know is kind of what that net asset value is going to do. Is it going to tank? Is it going to skyrocket? I think a lot of it is definitely dependent on the technology sector. Since the main way that this fund distributes its dividends is through these covered calls, in a bull market like we have right now, especially in the technology sector, they're going to be able to keep increasing dividends or paying whatever they pay right now. I think it's 60 cents per share. They're going to be able to keep paying these really, really high dividends. However, if the technology sector takes a hit, we may see these dividends start to go down. We may see net asset value start to go down. So it's very important to kind of temper previous performance with current performance. And as I said earlier, we don't know what QQQI would do in another global pandemic scenario or even a recession, since it's relatively new. We don't really know what JEPI would do in a recession either. You could argue that after COVID we had that recession. However you feel about it, the market didn't do well, and the stock price still did okay considering it was a recession or the market didn't do well. I myself keep my exposure to QQQI relatively low. Ideally, I want it in the 5 to 10% range of my portfolio. I think it's a little on the heavier side currently, closer to 13, anywhere from like 13 to 16%. So I'm slowly kind of going to lean the portfolio out because they don't really offer very much diversity as far as sectors go. Keeping my technology exposure to a minimum is probably the best course of action, for me at least. For you guys, it's your call. However, I would just be very careful when seeking super high dividends like QQQI. So, with that being said, guys, hopefully you enjoyed the video. Hopefully you took something away from it. Make sure if you enjoyed the content, like and subscribe, and I will see you guys in the next video.